I am Kazuya Hamazaki, CFO of Mitsui O.S.K. Lines. Let me start with a general overview. In our fiscal year 2025 first quarter results, we recorded business profit, which is operating profit plus equity in earnings of affiliated companies, of 50.9 billion yen, ordinary profit of 52.2 billion yen, income before income taxes of 61.6 billion yen, and net income of 52.8 billion yen. The energy business and the vehicle transport business performed strongly, and our results exceeded initial estimate. As a result, our balance sheet showed total assets exceeding 5.3 trillion yen, and shareholders' equity exceeding 2.5 trillion yen. During the first quarter of fiscal year 2025, we increased investment for stable revenue businesses, including completing acquisition of LBC Tank Terminals, acquiring an office building in central London, joining an offshore wind project in Taiwan, and signing a long-term time charter contract for a new LNG dual-fuel VLCC with Idemitsu Tanker. Looking at our fiscal year 2025 full-year forecast, we revised our initial ordinary profit forecast of 150.0 billion yen, upwards by 20.0 billion yen to 170.0 billion yen. Our previous forecast for net income has also been raised by 30.0 billion yen to 200.0 billion yen. While we must continue to monitor the impact on trade volumes of the introduction of additional tariffs by the U.S., we have roughly halved our initial estimate of the impact of tariffs of 40.0 billion yen based on cuts to the tariff rates and our first quarter results. Our exchange rate assumption is unchanged at 140 yen to the dollar. As for the Red Sea tensions, in line with our forecast at the beginning of the fiscal year, we assume there is no prospect of transit restrictions being lifted during fiscal year 2025. Due to the upward revision of our full-year forecast, we plan to pay an annual total dividend of 175 yen per share, which is an increase of 25 yen per share, in accordance with our shareholder return policy, which sets the dividend payout ratio at 30%. We are committed to maintaining our current dividend forecast of 175 yen per share, which represents a dividend increase, even if our performance forecast for the current fiscal year is lowered due to the impact of tariffs or other factors. Any additional allocation of free cash flow based on the latest upward revision of our performance forecast will be disclosed at the time of the first half financial results announcement. Our Chief Communication Officer, Sanae Sonoda, will now give an overview of the first quarter financial results, based on the financial results presentation materials. In the first quarter results, ordinary profit fell 56.3 billion yen year-on-year to 52.2 billion yen, reflecting downturn in the containerships business, compared with the previous fiscal year's strong performance. Income before income taxes fell 53.0 billion yen to 61.6 billion yen. Net income amounted to 52.8 billion yen, a decrease of 54.1 billion yen. Dry bulk business. The dry bulk business posted an ordinary loss of 3.4 billion yen, a decrease of 10.9 billion yen from the same period of the previous fiscal year. Looking at the rates for each type of vessel, the market rates for Capesize bulkers softened in April and May due to sluggish iron ore imports by China, resulting in a year-on-year decrease in profit. The market rates for Panamax and smaller vessels operated by MOL Drybulk had periods of improvement, reflecting an increase in ton miles and tighter vessel supply and demand due to trade measures between the U.S. and China, but the market rates for wood chip carriers and multi-purpose vessels were lackluster due to stagnant domestic demand in China. As a result, profit decreased year-on-year. The open hatch vessel business won highly profitable contracts for the transportation of minor bulk commodities, such as aluminum. However, the business was affected by weak demand for the transportation of its main cargo, pulp, as well as changes in accounting relating to the recognition of expenses, such as depreciation associated with the consolidation of Gearbulk Holding AG. Energy business. The energy business posted ordinary profit of 29.7 billion yen, rising 7.7 billion yen year-on-year, and helping to push up overall profit. Tankers and offshore business. The crude oil tanker market rates and product tanker market rates softened due to decreased shipments of petroleum products in China due to China's sluggish economy, and, despite profit contributions from long-term contracts and surging market rates during the Iran-Israel conflict, profit fell year-on-year. The market rates for chemical tankers softened from the previous fiscal year, impacted by China's economic slowdown and the introduction of additional tariffs by the U.S. In the FPSO business, stable profit was secured through long-term charter contracts, and equity and earnings of affiliates attributable to MODEC also contributed to profit. Liquefied gas business. In the LNG, ethane carriers, and gas infrastructure businesses, stable revenue from long-term charter contracts, as well as decreased expenses as a result of the rescheduling of dry docking for some vessels, from the beginning of the fiscal year to the second half of the fiscal year, and the recording of one-time non-operating income related to refinancing, resulted in higher profit than a year earlier. Product transport business. The product transport business, which includes the container ships business, posted ordinary profit of 30.2 billion yen, a decrease of 35.1 billion yen from the same period a year earlier, mainly due to a sharp decline in profit in the container ships business. Container ships business. Due to pressure from new vessel supply and the impact of the U.S. tariff policies, cargo demand especially on China-U.S. routes was weak, causing freight rates to decline year-on-year. Although spot rates for North America temporarily rose following the provisional agreement on tariffs between the U.S. and China in May, the contribution to profit in the first quarter is limited. In the first quarter, one reported after-tax profit of $86 million, and MOL integrated its 31% share of these earnings into segment profit as equity and earnings of affiliated companies. Please look at page 4 of the materials for details of changes in liftings, capacity utilization rates and freight index. Due to these earnings at our container ships business reported ordinary profit of 6.5 billion yen for the first 3 months, which represents a year-on-year decrease in profit. Vehicle transport business. In addition to firm shipping demand for completed cars, unaffected by tariffs, improved operational efficiency resulting from the easing of post-congestion in the Middle East and Australia led to increased profit year-on-year. Terminal and logistics business. The domestic terminal business remained firm. In the logistics business, shipments to the U.S. decreased due to the impact of U.S. tariff policies. Well-being and lifestyle business. The well-being and lifestyle business posted ordinary profit of 0.6 billion yen, a decrease of 5.0 billion yen from the same period the previous fiscal year. Real property business. Although existing properties continued to contribute to stable profit, profit decreased year-on-year due to the absence of one-off equity and earnings reported in the previous fiscal year. Ferries and coastal ro-ro ships business. In the ferries and coastal ro-ro ships business, both the logistics and passenger transportation businesses performed firmly, and profit was mostly unchanged year-on-year. Cruise business. In the cruise business, profit decreased year-on-year, partly impacted by the non-operating period of Mitsui Ocean Fuji. Associated businesses. The associated businesses posted profit mostly unchanged year-on-year due to the profit contributions of the tugboat business and the trading business. This concludes the summary of the financial results for the first quarter. Next, I would like to explain our fiscal year 2025 full-year forecast. We forecast ordinary profit of 170.0 billion yen, up 20.0 billion yen, from our initial forecast, income before income taxes of 230.0 billion yen, and net income of 200.0 billion yen, which represents an upward revision of 30.0 billion yen. These forecasts reflect our first quarter results and future performance forecast. Dry bulk business. The dry bulk business is expected to post an ordinary loss of 1.0 billion yen, representing a downward revision of 8.0 billion yen from our previous forecast. Capesize bulkers are expected to be less profitable than initial forecast, taking into consideration the possibility that market rates will soften on concern about a slowdown in China's crude steel production. Panamax and smaller vessels are expected to generate less profit than initial forecast, given that market rates will soften under the impact of China's economic slowdown and the impact of decreased Brazilian grain shipments. Open-hatch bulkers are expected to be less profitable due to decline in China's pulp imports and higher depreciation than initial forecast, due to the consolidation of Gearbulk Holding AG, despite expectations for firm project cargo demand. Under these market conditions, the dry bulk business as a whole is expected to show a loss this fiscal year. Energy business. The energy business is expected to post ordinary profit of 64.0 billion yen, which is a decrease of 2.0 billion yen from our previous forecast. Tankers and offshore business. Crude oil tankers are expected to see a steady profit contribution from long-term contracts. However, the previous forecast for product tankers has been revised downward on the expectation of reduced demand due to the stagnation of the Chinese economy and softer market rates due to increased new vessel deliveries through the latter half of 2025. The outlook for chemical tankers has been revised downward on expectations for softer market rates due to reduced cargo demand associated with the impact of additional tariffs and economic stagnation in China and Europe. The offshore business is projected to generate stable profits due to the contribution of existing long-term charter contracts in the FPSO business. In the LNG, ethane carriers, and gas infrastructure businesses, existing long-term contracts are expected to make a stable contribution to profit. However, we have factored in the impact of delays in the delivery of new vessels and reduced revenue as a result of equipment failure. Product transport business. The product transport business is expected to record ordinary profit of 106.0 billion yen, which represents an upward revision of 31.0 billion yen from the previous forecast. Container ships business. 1. Forecasts profit after tax of $700 million. While pressure from new vessel supply and the introduction of additional tariffs by the U.S. might disrupt the supply-demand balance, the outlook has been revised upward from the previous forecast based on careful examination of the impact of the disruption, given that the scenario of major global economic slowdown caused by tariffs is now less likely. MOL also thinks that this revised forecast is probable to the extent that forecasts are possible in the current circumstances, and we have also increased our initial forecast of $600 million by $100 million and factored this into our forecast. Please refer to one's response to recent changes in the business environment later on page 6 for further details. Our full-year forecast for the container ships business, including charter fees from ONE, is 42.0 billion yen, which represents an upward revision of 6.0 billion yen from our previous forecast. Vehicle transport business. In the vehicle transport business, we had initially assumed that shipping demand for completed cars would be weak under the impact of tariffs. However, judging from the first quarter results, the number of completed cars transported is expected to increase by 306,000 units from our initial assumptions. Accordingly, we revised our full-year forecast upward. Terminal and logistics business. In the terminal and logistics business, the domestic terminal business is expected to perform solidly, while in the logistics business, shipments to the U.S. are expected to decrease under the impact of tariffs. Well-being and lifestyle business. The well-being and lifestyle business is expected to post ordinary profit of 2.0 billion yen, which is a decrease of 3.0 billion yen from our previous forecast. Real property business. Daibaru, our core real property subsidiary, is expected to report lower profit than a year earlier due to acquisition costs incurred for newly acquired overseas properties. However, existing properties will contribute to stable profit. Ferries and coastal ro-ro ships business. In the ferries and coastal ro-ro ships business, the logistics business and the passenger transportation business are both performing strongly. Cruise business. We revised our initial forecast downward due to the non-operating period of Mitsui Ocean Fuji during the first quarter. In the cruise business, promotional sales activities are taking time to produce results. However, we expect to see gradual improvement in profitability. Associated businesses. In the associated businesses, we forecast performance in line with our previous forecast, with the tugboat business and the trading business expected to perform solidly. Turning finally to dividends, we are planning an interim dividend of 85 yen and a year-end dividend of 90 yen, making an annual total dividend of 175 yen per share. This represents an increase in our total dividend of 25 yen due to the upward revision of our performance forecast. This concludes my explanation of the fiscal year 2025 forecast.